Hey everyone, welcome to our mortgage market update for May. I'm Steve.
And I'm James.
We got some good news this week with the April jobs report, where it seems the job market may have shifted into a lower gear. After surprising growth over the winter, April's jobs numbers showed the job market pulling back a little bit. Employers added far fewer jobs than economists had expected, well below the average over the last year.
That's right, the unemployment rate climbed up to 3.9%, up from previous months, but it's still below 4% for 27 consecutive months now, the longest stretch in more than 50 years. And we've gotten so used to jobs reports exceeding expectations that it was a bit surprising to see one that fell short, and we saw a nice dip in rates because of it.
April's report was exactly what the Federal Reserve has been hoping for, an economy that is gradually cooling, but not plunging into a recession.
So far, though, cooling is probably not enough to persuade the Fed to cut rates. Jerome Powell, the Fed chair, said at their meeting last week that policymakers would not react to small moves.
Yeah, he's sticking to a cautious approach with the economy, as it's clear they're not afraid to hold rates at a multi-decade high to keep inflation in check. They played down the risk of more hikes, however, which was good to hear, as that conversation was back on the table recently due to stronger than expected inflation numbers.
Yeah, he added that Fed officials are prepared to maintain the current target range for the federal funds rate for as long as appropriate. But should the labor market continue to weaken, Powell said, policymakers are also prepared to respond.
Another item that is still very relevant as higher rates stick around for longer is loan assumptions. We want to point out a few things regarding VA assumptions that may not be common knowledge.
As most people know, assuming a loan allows a buyer to take over the existing loan at the current loan amount, current rate, current term. It can be a great deal for the buyer. But it's important that the puzzle pieces all fit together with regards to down payment.
Additionally, the buyer doesn't have to be a veteran to assume a VA loan. If the loan is assumed by a veteran, the existing VA entitlement can be transferred to the VA eligible buyer, thus freeing up the entitlement for the veteran seller to use on a new VA loan.
However, if the loan is assumed by a non-veteran, the existing entitlement utilized to get the original VA loan remains tied up for the seller until the VA loan is actually paid off. And if you're a buyer who is able to assume a super low VA loan from a veteran seller, just another reason to thank the veteran for their service.
And also, with all assumptions, be prepared for an extended close time to get through the assumption process. It's definitely no walk in the park.
Hey, something that we're seeing in the market as high rates linger longer than expected are temporary rate buydowns. If you don't know the ins and outs of a temporary rate buydown, the main point of emphasis here is that if were rates to come down in the near future while borrowers still within their buydown period, they could refinance into a lower rate, and most importantly, whatever funds are left over in the buydown account are credited back to the borrower when they close on the refinance or sell the property.
That's right, there's no break-even period on a temporary rate buydown. So even if a borrower refinances or sells before the end of the buydown term, they aren't losing any of the money they initially paid for the buydown or the seller initially paid. It can be a pretty great product in the right situation. It sounds complicated, but really isn't that complicated.
Yeah, that's right. Reach out if you have any questions, and as always, thanks for tuning in.